Hi, welcome to Picture Perspective. My name's Jordan Kennedy. Today we've got the opportunity to have Curko, our economist, back in the hot seat. Let's go. From a legal perspective, this is general advice. If you need personal advice, please reach out to one of our advisors. So Cameron, what's changed in the US and why are people talking about rate hikes for some unbeknownst reason?
Yeah, so the big thing in the US at the moment has been really on the inflation front. So what we've seen in recent months is a couple of signs of inflation not continuing to go down, but in fact inflect slightly upwards. Like we were meant to have an orderly, gradual transition where inflation gets back to target, the Fed cuts rates 2 to 3 times this year, and sunshines and rainbows essentially. And that is not looking like it will necessarily happen. So you've seen a bunch of people come out and put out their own spin, but to the extent that the Fed might cut, people are pushing it back all the way to their November meeting.
So are we longer at these levels? Do you think we are? The inflexes of going up, do you think that's a real possibility or do you think it's talk?
So look, it's a tricky question to sort of tease out some of the numbers that you are seeing out of the US. It definitely seems like there's a case of higher for longer. So for context, US rates are full percent higher than ours, in the 5s, but the US economy hasn't blown up at those rates, and growth has continued to track pretty well versus most countries. So, and the labour market as well has also held up quite strongly. So the Fed, in that kind of context, might be comfortable with just sitting on the sidelines for a bit longer.
So from my perspective, I've always, of the last couple of months, talked to my clients and prepared them for more of a time of hold, as opposed to this theory we're going to reduce. I think people need to get prepared to what the new normal is, and I feel like we're in the new normal phase. So interesting insights. Thanks, Cameron.
No worries.
So Cameron, from what we're seeing, what are the broader implications on the stock market?
Yep. So I think what we're really seeing investors try and struggle with is a few factors. So if interest rates are higher for longer, that's going to hurt anyone that holds a bunch of debt. So like your utility stocks, real estate, and the like tend to be more interest rate sensitive. So, and it's going to impact their margins. But then we're also trying to juggle this narrative that AI is here. We are spending tens or hundreds of billions of dollars at the moment in USD on this sort of AI arms race amongst all the leading tech giants. And funnily enough, even stocks that are normally super interest rate sensitive, like utilities I just mentioned, they actually have a growth story from AI. Like to power all the data centers you need to do all this computing power, you actually need a lot of energy. And so they might actually, for the first time in really a couple of decades, have a real growth story for, particularly in the US, but globally for utility stocks. So markets are really trying to grapple between the two. Realistically speaking, what does it mean for markets? I think as long as you have a meaningful growth narrative and investors are willing to go along for the ride, you will continue to trade at a premium valuation, particularly versus the rest of the market, which is still juggling with a bit of a slowdown in the consumer. And so for certain markets, so what I've got on the slides there is just showing US in black versus the rest of the world in orange. And the US has continued to enjoy a bit of a premium over the rest of the world because, one, they're not as interest rate sensitive. Two, the US economy has been growing stronger. And I think in the near term, we'd expect some of that premium to persist. The question mark will be like, when do we see that leadership meaningfully shift? And that's still probably not a 2024 story. It might be even beyond that if we start to see the EU and other parts of the world inflect.
What about the tech stocks? We've seen sort of analysts start to re-rate. I think it was 6 out of the 7 major tech stocks in the US. Is that sort of overlay onto your slides at all?
It does. It has implications. So these kinds of charts can be misleading because the composition of the market has shifted materially. But what we tend to see is the tech stocks make a lot of money. They're very high quality recurring revenue. And for that kind of business, you tend to be willing to pay up a little bit more versus your more cyclical names that are very sensitive to, say, commodity prices, which as an Australian, we tend to see your BHP and Rio dividends, for example, are very sensitive to where iron ore trades in a given year.
Yeah, and I think we've seen, if you talk on BHP, we've seen them potentially launching a takeover bid of a pretty large company. How does that affect us down here?
So that it was firstly a bit of a cheeky bid in the sense that arguably it undervalued the takeover target Anglo American.
The market didn't seem to like it, right? It was off sort of 5% off when it all leaked out.
Yeah, and I think the reasons for that are to recap, previous mining cycle where the Aussie economy was booming, we were building all this stuff, and wage growth was elevated, times were good. At that moment, commodity prices were high, and you saw the likes of BHP, Rio, and others do all these acquisitions that tended to go quite badly for them, and they've had to basically they overpaid. They basically had to unwind all of these positions and take some decent hits on them. And look, they found religion. They were paying more dividends. They were doing share buybacks, and they were generally being a lot more efficient. And now the concern is they're starting to get tempted by these growth stories. Are they going to fall on their bad ways? Because that is a huge ticket for someone of their size to write. And the bid itself was very complicated. So I think investors were understandably quite jittery. But the fact that they said it makes me think, even if they don't do this one, and other investors are going to think this as well.
They're going to do something else.
They're going to do something else. And
let's bring it back to the Australian economy. Talk to us about what you're seeing, what you're hearing.
So really, fast forward a few months, the Aussie economy, it's really a case of more of the same. So we're having population growth running at near record levels, but household spending in sort of volume terms, which if you look at the slide, the blue line has been tracking flat for several quarters now. And really, when we get the next set of GDP numbers, I'd be very surprised to see if that materially inflects higher. People are generally struggling.
Battening down the hatches, doing everything they can, and we're starting to see it.
Yeah, and you've seen that pattern just recur across the economy. There are certain sections where, you'd say wealthier households tend to dominate the spending that have held up better than expected. But outside of those, the general economy has really borne the brunt of the RBA hikes.
So Cameron, where to with the RBA?
So in terms of the RBA, they're facing a bit of a tricky situation. So on the one hand, when you break inflation down, goods inflation is doing what you'd expect. We had a lot of COVID disruptions and everything else, so it saw the prices of goods go up. And as those backlogs have eased, we've seen goods inflation come down substantially, and now it's at 3%, the top end of their range, which, look, and you'd expect it to potentially come down a little bit more potentially. But the problem for them is on the services side. And so this is where things like wage growth feed through, but it's also where a lot of government-controlled sectors reside. So when we talk about things like education and healthcare, for example, a lot of that is influenced by government spending and government decisions. So, for example, within the education category, university fees, inflation index. And so because that's a backward-looking mechanism, you have the feed-through of higher inflation come into that services inflation category. But there's also categories where just the blunt reality is the RBA hiking rates is not going to fix anything. So insurance is a classic one. And if you look at the slide, that's the one in the teal that's running at the hottest. And that's something every Australian's feeling, whether it's your motor insurance, your house insurance. And that's not something the RBA hiking rates is going to really easily fix. You're having households, they can cut back where they can. They can they can increase their excesses, they can reduce their coverage, but it's not a perfect solution. And so really, when I hear people in the media say, oh, the RBA needs to hike to control it, I'm like, it's really a but situation. And the but is doing a lot of the heavy lifting in this case. Where will I expect the RBA lands? I think, so we were talking about the Fed earlier. I suspect the RBA will probably land on a muddle through course where they keep rates where they are. They might add a bit of hawkish rhetoric in their statements, but they ultimately won't actually move to increase rates. They'll just push back the prospects of rate cuts.
Thanks, Cameron. Really interesting perspective. Thanks everybody for tuning in. Hope you've enjoyed the journey. Please reach out to any of your advisors should you wish to continue the conversation. Thanks again.
Thanks, John.